The journey into Bitcoin often begins with excitement, but for many newcomers, it ends in frustration and loss. The path to long-term success with this revolutionary asset is not paved with speculative luck. It's secured by avoiding a set of common yet often fatal mistakes that stem from misapplying traditional financial thinking to a completely new monetary system. Recognizing and avoiding these pitfalls is the true key to preserving capital and capturing the incredible upside of Bitcoin. The single most destructive error is adopting a high time preference speculative mindset. New investors are often drawn in by headlines of parabolic gains and assume they've found a way to get rich quick. They see Bitcoin as a highly volatile tech stock to be traded. They buy in after a large run-up, driven by FOMO, expecting it to continue indefinitely. When the inevitable 50, 60, or even more percent correction hits, their lack of fundamental conviction kicks in. They panic sell at the bottom to save the rest, locking in a loss, only to watch the price roar past their entry point months later. The fix? A low time preference accumulation strategy. The successful Bitcoin investor sees the asset as a generational store of value, a digital savings technology. The antidote to a speculative trading is dollar cost averaging, or DCA. This disciplined approach means committing to buying a fixed, small dollar amount of Bitcoin on a regular schedule, like weekly or monthly, regardless of the price. DCA forces you to buy more units when the price is low and prevents emotional buying when the price is high. Your goal shifts from timing the market, which is nearly impossible, to maximizing your time in the market and accumulating the scarce asset over the long term. This strategy transforms the volatility from a source of anxiety into an opportunity to buy cheaper. In traditional finance, banks and brokers are seen as the secure place to hold assets. This thinking is a dangerous liability in the world of Bitcoin. The second biggest mistake is leaving your Bitcoin on a centralized exchange like Coinbase, Binance, or Kraken. When these companies are regulated, they operate under the rules of a fractional reserve banking and are subject to hacks, regulatory seizures, or insolvency. When your Bitcoin is on an exchange, you do not hold the private keys, the exchange does. The core of Bitcoin is not your keys, not your coins. You're entrusting your decentralized, permissionless asset to a centralized third-party risk vector. The fix is to learn self-custody and get a hardware wallet. For any amount of Bitcoin that matters to you, the solution is self-custody. This requires purchasing a hardware wallet and learning the process of securing your seed phrase. This seed phrase must be stored physically, securely, and offline. This initial setup requires a small investment in time and money, but it is the only way to convert your Bitcoin from an asset held by a third party to truly sovereign wealth that is immune to bank bail-ins, exchange hacks, or government seizures. Many new investors skip the crucial step of education. They buy Bitcoin because a podcast told them to, but they don't understand the monetary thesis. Consequently, when the market crashes, they lack the conviction to hold because they don't fundamentally understand why the asset is valuable. This lack of conviction often leads to the second part of this mistake. Chasing high-risk altcoins, they see an obscure coin promise 100x returns and divert their capital away from the proven secure asset. These altcoins lack the decentralization, security, and proven scarcity of Bitcoin, making them extremely risky speculations. The fix is to study the fundamentals and understand scarcity. Before investing a significant amount, dedicate time to understanding the Bitcoin white paper, the concept of proof of work, the halving cycles, and the history of fiat currency debasement. Build a strong personal thesis for why Bitcoin is the best monetary technology available. If you believe the 21 million supply cap is immutable and essential for the world, a 50% price drop is not a reason to sell. It's a massive buying opportunity. The wise money focuses overwhelmingly on Bitcoin and avoids highly speculative altcoins until they have a deep technical understanding of the risks. Enticed by the promise of amplified gains, many new investors make the fatal error of trading with leverage. Leverage allows you to borrow capital to magnify your trading positions in the hyper-volatile Bitcoin market. Using leverage of double, 5x, or 10x is a near guarantee of liquidation. Even a small, typical market swing can wipe out your entire collateral, leaving you with nothing. This turns investment into pure gambling and accelerates the destruction of capital. The fix is to stick to spot purchases and avoid debt. The Bitcoin thesis is about accumulating a hard asset, not gambling on a short-term price movement. Only buy spot Bitcoin, meaning you pay in full for the asset. Use only money you can afford to lose. The goal is to survive multiple market cycles and capture the long-term appreciation, which is impossible if your position is subject to forced liquidation by an exchange. Discipline over leverage is the definition of a successful long-term hodler. Of course, none of what I said in this video is financial advice, and it's all for education and entertainment purposes. If you want more videos about Bitcoin, more no BS advice about investing, avoiding mistakes, about the technology, and everything about Bitcoin, make sure to subscribe to the channel. Thank you for watching, and I will see you in the next one.